In this week's video, we'll review the latest charts to help us better understand the most important question for investors. In the context of high stock market volatility, new concerns about the virus, and a Fed that's about to accelerate its tapering process, might be helpful to look at the credit markets. This is the fear spike from the original COVID surge in Q1 of 2020. This is the look that we would like to avoid. We have seen a little bit widening of spreads, a little bit of an increase in fear, but what we have in the present day, and this is the reading here as of December 2nd, is nothing like this. How about access to credit or financial conditions? Basically the same answer. The latest reading that was published from the Chicago Fed relative to their National Financial Conditions Index was on Black Friday, after Black Friday. This is the type of look that we want to avoid. This is tight credit conditions, low trust, shaded areas are recessions. Credit conditions below the horizontal line are better than average. Don't really see anything particularly alarming here, but given the news of the day, we'll continue to monitor the credit markets with an open mind. Given the high volatility that we've experienced in recent weeks, it might be helpful to take a step back and try to better understand what our objective is here. Our objective, long-term investors, your objective may vary, is to navigate between a point A and a point B that may be several years down the road. In this case, this is 1988 here. This is the spring of the year 2000. Between that point A and point B, the S&P 500 gained 518%. And if the market went up every single day, it would be very, very easy to navigate between that point A and a point B that may be several years down the road, because your balance would go up every day. You'd be getting positive feedback every day. There'd be no need to change your portfolio. Unfortunately, that's not the way it works in the real world. Even in the context of the strongest trends, in this case a secular trend, we're in the middle of that secular trend that began in 1982. Typically, there's a lot of volatility between a point A and a point B that will occur several years down the road. And we have numerous tools that can help us capture that 518% or a portion of it, including the simple 200-day moving average shown in red on your screen. For the most part, markets are healthier when price is above an upward sloping 200-day. If we shift to a weekly time frame, similar situation. For the most part, all things being equal, risk is lower and markets are healthier from a very long-term perspective when price is above an upward sloping 200-week, in this case, shown in red. During these periods of 100% normal and to be expected volatility that occurred between that point A and point B, it can be helpful to take a step back and look at the monthly time frame. As we've covered in recent weeks, typically your strong trends for the most part stay above an upward sloping 10-month moving average shown in blue, and occasionally they may dip into the territory of the 40-month moving average shown in red. And if we're going to try to navigate between that point A and point B, our main objective is to try to discern between volatility to ignore within the context of an ongoing and existing uptrend, and volatility to respect, shown here on a monthly time frame, when risk needs to be managed more closely, similar to this rollover look here in the spring of 2000, and this rollover look here that started in October of 2007. Pretty easy to see that a strong uptrend on a monthly time frame relative to the 10-month moving average looks discernibly different from a longer-term downtrend on that same monthly time frame. Relative to the daily, weekly, and monthly guideposts that we've just covered, how does the present-day chart of the S&P 500 compare? Even when the S&P 500 was down on the daily chart, this is intraday, Friday, December 3rd at 12:32 p.m., the S&P was down 69 points. It ended up rallying into the close and finished down 38. But relative to the 200-day moving average, it's very, very difficult to say that this is anything other than a strong and existing uptrend. And if we were to look at this period here, it probably looks most like this period in 1995 and into 1996. Similar situation on the weekly time frame. The S&P 500 on December 3rd remains well above an upward sloping 200-week moving average shown in red. Hard to make an argument that this looks discernibly different from this secular trend shown on your screen. Before we look at the monthly chart in the present day, all things being equal on all of these time frames, we would prefer to have price above an upward sloping moving average relative to price below a downward sloping moving average. Intraday on December 3rd, S&P down 57 points. When this chart was printed, we have price above an upward sloping 10-month moving average and price well above an upward sloping 40-month moving average. Probably fair to say this still looks a lot more like this relative to this rollover look here or this rollover look here. Common sense tells us that if the present day market is eventually going to morph into something like this or this, that damage would start to show up on a daily time frame prior to a weekly and a monthly time frame. So let's take a closer look at the present day daily chart of the S&P 500. This is the simple 200-day moving average shown in red. And one of the great things about charts is we don't really need to know the context of the chart. If you were taking a technical analysis test, a multiple choice test, and you were asked, is this an uptrend, a downtrend, or a market that's consolidating? This would be very, very easy. You would pick uptrend very, very quickly and move on to the next question. Why would you do that? Even when the S&P 500 was down 70 points intraday on December 3rd, the market was well above an upward sloping 200-day shown in red. And maybe more importantly, price continued on this time frame, even the intermediate term time frame, to make a series of higher highs and a series of higher lows. The last thing this chart did was make a new all-time high. We may make a meaningful low, but we haven't done that yet. To do that, we would have to undercut the October low. It's probably also fair to say, if the monthly chart is eventually going to roll over and we're going to get a situation where we move from volatility to ignore and we shift to volatility to respect, where some type of defensive action needs to be taken, before we get a look like this, we probably need to have evidence in hand that says even this short-term move in the S&P 500 from this point A, the October low, is in jeopardy. Fibonacci retracements help us answer that question. It is 100% normal and to be expected for an uptrend to have retracements. Not unusual to go back to the 38.2% retracement. Not unusual to retrace 50% of a move. Not unusual to retrace 61.8, and even 100% is not unusual. And how that's helpful is when you have a retracement like this, it tells you the probability of the uptrend continuing is relatively high, versus if you take out this, and this, your probability of a trend reversal is starting to increase. Thus far, we haven't even exceeded the 61.8% retracement of the A to B move from the October low to the recent high. And this is somewhat of the first line of defense look here. We've got an upward sloping trend line in blue. You can also calculate a fib from this A to B. You can calculate a fib from the May low to the recent high. And this is just telling us that price presently has potential support in the area. If we use the term support, it implies that the market is going to hold. We should be saying possible support. If this doesn't hold, and we have no idea whether it will or not, there are a lot of other areas of potential support that are still between price and that upward sloping 200-day moving average. This is a trend line, this is a trend line, here's a trend line, here. So if we're trying to navigate between a point A and a point B that may be several years down the road, we really don't have any evidence in hand during the session on December 3rd when the S&P was down 60 some odd points that tells us the long-term trend is in serious doubt at this point. And there are numerous things to consider between this point here where price is on Friday, December 3rd and that upward sloping 200-day moving average, including numerous gaps in this area here. Gaps are basically levels that the market said were important in the past. Just because a gap has been filled doesn't mean that level isn't important relative to the market. If it was important here, 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 and here, it's also possible that it's going to be important in this level here if we revisit it. All of these are guideposts, possible support. If they hold, we learn something about bullish probabilities. If we move into this area here, below all of these forms of possible or potential support, we learn something about bearish probabilities. And from a risk management perspective, you're not assuming any of this is going to hold. In fact, you're preparing for just the opposite. So a chart like this would help us if the market plunges in this direction. And if it does so rapidly, we want to have some guideposts that we can manage against, rather than getting caught off guard. So if you're a client, a chart like this, a chart like this, we have charts like this for every position in our portfolio. And you can take all of the annotations and all the markings off of this chart. If you just looked at price alone, very, very difficult to say that this is anything other than an uptrend at this point. That's subject to change, but at this point, this move here really isn't discernibly different from this move here that was eventually followed by higher highs, this move here that was eventually followed by higher highs, this move here that was eventually followed by higher highs, and you get the idea. Given the facts that we have in front of us, the chart in front of us on Friday, December 3rd, isn't particularly alarming at this point. Concerning? Sure, it's concerning. This is concerning here, this is concerning here, this is concerning here. From a risk management perspective, it can also be helpful to better understand how your weaker positions in the market are holding up. So this is VTV, value stocks in the ETF world, relative growth stocks, SCHG. Value stocks outperformed growth significantly on December 3rd, but that doesn't change the trend. The slope of the 200-day moving average is sloping down against value. This trend line is downward sloping, and in recent months, the ratio has been making a series of lower highs and lower lows. And the same can be said for value versus the S&P 500. VTV is still a laggard relative to the S&P 500. It's consolidating, telling us it's possible there could be a trend reversal, but it's also possible this consolidation will be followed by a resumption of the downtrend. We don't have anything in hand on December 3rd that says the trend is flipped favoring value over the S&P or growth. Thus, it might be helpful to know. In recent weeks, a laggard, the chart of value in isolation, VTV, still looks pretty good. It, too, has not made a discernible or important lower low. We would have to undercut this low here. We haven't done that yet. And price still remains above an upward sloping 200-day moving average shown in red. The assessment of the probabilities would change significantly if price moves down here. The longer it stays below that 200-day, the more meaningful it would become. But right now, this is still an uptrend. So one of the market's laggards still looks healthy. The market itself still looks healthy. Hard to argue that when you look at this chart here where my cursor is. This was the look of VTV around 3:20 p.m. on December 3rd. We look at the high-low close, another important element. The S&P 500 was making lower lows here relative to the shorter-term move. Look at value. On Friday, it's well above the low that was made on Thursday, and on Friday, the low here is well above the low that was made on Wednesday. We can at least make an argument that it's trying to make some type of stand above that upward-sloping 200-day moving average. What about tech stocks in the context of an accelerated taper and interest rates? Do we have something on the daily time frame that looks like we're flipping from volatility to ignore into something that looks more like volatility to respect? It's difficult to say the answer is anything other than no at this point. The last thing XLK, the tech ETF in isolation, did was make a new all-time high here. Sure, it's given some back. It's had somewhat of a retracement here. The big drop in tech in recent days is really not surprising. In fact, it's to be expected. It's typical for your leaders to be the last ones to fall, but that doesn't necessarily mean the whole trend is rolling over. We would be more concerned about tech if more of our laggards start to roll over. But right now, the laggards are trying to make a stand near logical levels, which tells us tech in isolation may try to make a stand near some type of logical level that exists between price on December 3rd and that upward sloping 200-day. There's nothing magical about the 200-day. Stock market goes up 518% from January 1st, 1988 until March of 2000, and you can see price falls below the 200-day moving average numerous times between point A and point B. It is simply a reference point. But it's fair to say when you're above the 200-day, it's better relative to being below the 200-day. Tech in isolation remains well above an upward sloping 200-day moving average. And even with the big drop in recent days, we really don't have anything particularly damaging on the relative chart either. This is a multiple month period of consolidation, XLK, relative to SPY. This is a bullish breakout and a little bit of a give back. Haven't even retraced to the first fib retracement relative to the A to B move from May to this B here. As always, we're making statements about the charts in front of us. We're not predicting whether this is going to hold up, whether this is going to hold up, or whether the S&P 500 is going to maintain a look like this. But those are the charts in front of us today. Another relevant point, this is SCHX. It's very similar to SPY or the S&P 500. Similar positions, similar weightings, and a very, very high correlation. Also noteworthy, here's the market intraday on December 3rd. The rally from the October low, this point A to this point B, really started to take off and become serious here after this gap up. So 2 points of reference on numerous charts. This gap here and the October low, because to make a series of lower lows and lower highs, eventually we're going to have to undercut the October low. So here's a reference point and here's a reference point. Here's a look at the same chart at the close on December 3rd. Price held here. It held here near the October low, and we're back to that upward sloping trend line, and thus far we have held in a logical area. The equal weight S&P 500 RSP is a laggard. You can see price here is trying to make a stand near this gap. Price also remains above an upward sloping 200-day moving average, and it seems to be respecting this trend line here for now. We would learn something about the probabilities for the market and market leaders such as tech and growth if RSP, VTV, and other laggards start to roll over. Right now, we just don't have it. Does this look like a weakening trend? Absolutely, positively, yes. There's no question from here to here, this trend is weaker relative to this type of strong move here. Similar concepts here. If you looked at a chart of SCHB divided by SPY, the broad market, more positions, is a laggard. We also have another laggard that for now is holding above this gap up from early to mid-October. It's holding above this upward sloping trend line, this very short-term trend line, and holding above that upward sloping 200-day moving average shown in red. What does a more concerning chart look like? Well, here's FDN. You can see this here. We've got several closes now below a 200-day moving average that looks like it's trying to roll over. That's the bad news. So there is some evidence here, relative evidence on the chart in front of us. This is a yellow flag at this point. For now, we're still in this consolidation box here, but this looks different from everything that we've seen from this point here in April of 2020 to the present day. Still have some areas of possible support, but the probabilities have deteriorated a little bit here relative to here. These are the moving averages that we've covered several times in recent weeks and months. This is a December 3rd close. We don't have a full-bore bullish look because price closed just barely below the blue 50-day moving average. But for the most part, price is above all the moving averages here and the slopes remain up. Hard to say that the present-day chart on December 3rd looks discernibly different from this strong-looking trend here in 1996. There is some volatility if we move out this way in 1996, but nothing major, and the market, for the most part, the uptrend remains intact until the spring of 2000. Many of you have probably read The 7 Habits of Highly Effective People. Habit number 2 is begin with the end in mind. What is our goal here? Our goal is to navigate between that point A and point B. Our goal is not to try to sell at this peak and buy back at this bottom. That may be a noble goal for someone else, but that's not our goal. It would be wonderful if this is how markets operated in the real world. It would be great if our balance went up every single day, and when our balance made a new all-time high, we never gave any of it up. But in the real world, if we want to navigate between that point A and point B, we have to be willing to tolerate a lot of 100% normal and to be expected volatility. And from a probability perspective, it's not likely that this look lasts. It's not likely that this look was going to last, and it didn't. What do we mean by that? Walking forward from this point until the spring of 2000, the market did become more volatile, and the drawdowns were bigger. And if we follow a typical path, it wouldn't be shocking sometime in the next 12 months to get a larger drawdown. But common sense tells us that a drawdown doesn't necessarily mean the bull market is over. And if we're still in a bull market, that means we're in an uptrend. And that's helpful because a bull market eventually makes a higher high. Here's the look of our chart. December 3rd at the close, S&P down 38 points. It's pretty fair to say the look of price relative to the moving averages isn't particularly concerning. Is it possible that we're going to morph into a look like this, or a look like this, or a look like this? We know the answer. It's absolutely positively yes. It may happen soon, but it hasn't happened yet. There are a handful of concerning things here. We can find charts that look like this. This looks different. This is telling us to pay closer attention. This is telling us not to make any assumptions about this holding in here and not to make any assumptions about price staying above a 200-day. Recent moves in the VIX also concerning and telling us to respect risk. This is the look of the VIX close on December 3rd. On December 1st, right here where my cursor is, this is a relatively rare move. The VIX moved from 15.01 on a closing basis down here, and in less than 50 calendar days, we exceeded on a closing basis 31. You can see here from a character perspective, this is starting to look different from what we've seen over here, and the 200-day moving average starting to turn up a little bit here, so we have to respect this. Thus, it's helpful to ask and answer. How many times in the history of the VIX, which only goes back to 1990, have we seen a move like this that occurred in 50 calendar days or less? The answer is 4 previous times, 1990, 2015, 2018, and February of 2020. This is a pretty scary looking table here, and it serves a purpose. It tells us to be ready for worse than expected outcomes. However, if you look at the average and median performance in the S&P 500 down here, it's not particularly alarming. And in every single case, the S&P 500, all 4 of them, was higher 9 months later, 1 year later, and 2 years later. Average gain 2 years out, about 25-26%. 1 year later, about 15%. 9 months later, about 11%. But these cases are relevant here. The 1990 case and the COVID plunge case. So this is S&P 500 performance walking forward from the date of the signal that in this case would be similar to walking forward from December 1st. December 1st is the highest close that we have on the VIX in this move here. On the 2nd and 3rd, the close was below this level. So this is S&P 500 performance. This is what the drawdowns look like from the date of this signal. The maximum 6-month drawdown. So think walking forward from December 1st. After a similar move in the VIX, the S&P, the maximum drawdown over the next 6 months in the 1990 case was over 14%. during the COVID plunge, it was almost 25% after the VIX made a move like this. If something similar happened in the present day, from the date of the signal, December 1st, these are the hypothetical drawdown numbers in the present day S&P 500. The average drawdown down to about 4,000, the median drawdown to about 4,100. However, these are binary outcomes. This is really bad, this is really bad, this isn't really bad at all, and this isn't that bad. And if we put these drawdowns on a present day chart, you can really see that. Two of the outcomes, hypothetically here and here, so the pink and the green line, if we experienced a similar additional drawdown from the December 1st close in the S&P 500, in both cases, you would remain above an upward sloping 200-day moving average shown in red. It's a big difference in the other two cases. You'd move all the way down here near this red horizontal line, and in the COVID plunge case, if we saw something similar again, we'd move all the way back to the level seen in the S&P 500 in November of last year. This looks like an uptrend if we move there. This looks like an uptrend. This is starting to check downtrend type boxes. So on this time frame, you'd be moving into volatility to respect and volatility to respect. Doesn't necessarily mean you're there on the longer time frames. The model in our approach is a multiple time frame approach. Why this is helpful? If you're too bearish, this case and this case says you better keep an open mind about better than expected outcomes. If you're myopic from a bullish perspective, what just happened in the VIX, this is observable evidence, this is the chart in front of us. In two of the four historical cases, the market fell a lot further from the date of this signal, telling us to keep an open mind about worse than expected outcomes. Similar situation here. This is TLT in isolation. Multiple month consolidation box. We get a breakout here. This is almost like a fear breakout on TLT recently. So that would be the bad news. Keep an open mind about worse than expected outcomes. The potential good news, it's only retraced 61.8%, this line here, of this A to B drop. So right now, you can make an argument this looks like a normal retracement within the context of this downtrend. But a mixed bag. We have price now above trying to turn back up 200-day moving average. So this chart and this move in the VIX makes it easy to respect and understand that while we're still in on our time frame, for the most part, volatility to ignore, it's very, very possible we could shift into volatility to respect. To recap, the charts in front of us on a daily time frame. This is what we have today. Weekly time frame, not discernibly different from the look here between 1988 and 2000. If we look at this period in here, not discernibly different from what happened several times between that point A and point B, where the S&P 500 gained 518%. The market's trend still looks like the 1995-1996 period. We can't say the same thing for this level of the VIX. Let's talk pros and cons. We unquestionably in the present day have numerous yellow and red flags. We've seen signs of distribution, which is basically signs of institutional selling. We've had heavy volume on down days, heavy volume in ETFs on down days, and very, very lopsided breadth, negative breadth. And we haven't had enough positive breadth at this point as of December 3rd to offset that. As we just stated, the VIX in the present day is drifting from this script. If you go back and look at a chart of the VIX, about as high as the VIX gets in this period is about 22. We are well above that in the present day. And these red numbers here, and this red drawdown here and here makes it very, very easy to move out of any type of myopic bullish state. Got a lot of unknowns still relative to the virus, and we have a significant shift and not a particularly bullish shift relative to the Fed. And this is also tied into the issue of inflation and interest rates. On the other side of the coin, On our time frame, if you look at the charts objectively, and remember, you don't have to put a but on the chart, but the virus, but the Fed, but the volatility. The charts are taking all of that into consideration. The charts on our time frame, for the most part, look vulnerable, but they have not rolled over yet. And our laggards, thus far, for the most part, are holding above key areas. That may change very, very soon. This may change very, very soon. But neither of them have changed yet. The VIX is concerning, however. There's only been 4 similar spikes in the VIX in the entire history of the VIX. 2 of them, very concerning. 2 of them not particularly concerning. In fact, from the date of the signal, the average drawdown in those 2 cases, the ones that aren't particularly concerning, after the signal was about 3%. And then the market started to march higher. In terms of keeping an open mind about better than expected outcomes, typically, long-term bear markets, multiple years, multiple months, drawdowns that are 50 some odd percent, take place in the context of a recession. This is a headline from December 3rd. We really don't have a lot of evidence in hand that's screaming imminent recession. And even this week, this is Home Builders ITB. The CTF made a new all-time high on Thursday of this week, December 2nd. So really, nothing's changed relative to our approach. If we're going to successfully discern between volatility to ignore and volatility to respect, and that applies to all time frames, daily, weekly, monthly, the only way that we can do that is to trade the chart in front of us. And that requires us to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.